via email following the presentation. If we are unable to answer any questions during the presentation today, we will follow up with you via email. Additionally, please reach out to our speaker, Stephen Bland, at publicsector@raymond.com. With that, let's introduce today's speaker. Welcome, Stephen. Stephen is the Education Director for the West Michigan chapter of the Association of Government Accountants and is a principal at Raymond, where he serves as the firm's Director of Governmental Audit Quality. Stephen is a CPA and a certified government financial manager with 25 years of experience in the government and nonprofit arena. He's also a member of the AICPA's Government Audit Quality Center Executive Committee. With that, Stephen, let's go ahead.
Thank you very much, and good afternoon, everyone. Welcome to our session on governmental accounting and auditing in a pandemic. I sincerely hope that this becomes one of those topics that we say, why did you bother recording it? No one wants to go back and look at that someday. But for now, this is the world we live in, and we've got some important things to talk about. So let's go ahead and take a look at our outline for today. We're going to spend just a few minutes providing the background and timeline that I'm sure everybody knows and is very familiar with. And then we're going to divide the session up into two different sections. One, how to account for a pandemic. That's going to be GASB guidance for governments and what they're supposed to do relative to all the different things that might happen in pandemic accounting. The two places that we've got guidance on this are the GASB's emergency toolbox. We'll explain what that is and walk through that together. And then a standard issued in the midst of the pandemic, Technical Bulletin 2020-1, which is authoritative GAAP, and we'll walk through that as well. In the second half of our presentation, I'm going to shift gears away from the accounting from the pandemic and focus more on the auditing side. For those of you who are in the auditing community, this is going to be geared very much towards you. For those of you who get audited, this will be an insight into the mind of what's going on at the CPA firms and government audit agencies that are having to do their job in very unusual circumstances. So that'll be the second half. And then at the very end, we're going to take just a talk about a few updated information that's available for applications. There is a lot that is currently under development. Kind of hoped when we scheduled this we'd have a little more finalized that we could share, but we'll give you the information that we've got and do the best we can. I am getting some feedback. We'll have some audio issues, so during the first when we get there, I will try to do a switch over. Hopefully you can stay with me in the meantime, and we'll get that corrected as quickly as we can. So background and timeline information. On December 2019, just in time to give COVID-19 its number, pneumonia of unknown cause was detected in Wuhan, China, and was first reported to the World Health Organization. By late January, that had been created to a public health emergency of international concern, and by February, we had the name COVID-19 that everyone is so very, very tired of hearing at this point. By mid-March, the World Health Organization characterized COVID-19 as a pandemic. The president had declared a national emergency, and for those of us who are here with AGA West Michigan, our governor in Michigan, Governor Whitmer, signed our version of the stay home, stay safe, shelter-in-place order that other states had very similar types of things around that same timeline all over the country. So in response to all of that, what happened was the GASB offered an emergency toolbox. The emergency toolbox was intended to address issues that were rising out of this. And here's from the actual GASB. They said, operating under today's difficult circumstances, may raise certain accounting and financial reporting issues that are not commonly dealt with by governments in their own. So this toolbox that the GASB is rolling out is to help stakeholders quickly identify the GASB's guidance that might be relevant under these circumstances. Essentially what they're saying is, at this stage of the game, the GASB was not issuing any new rules, but they were helping us understand how to best apply the rules that are there. All right, we're getting enough feedback here. I'm going to go ahead and pause a little earlier than I had planned and get the audio switched over. So we'll take just a very brief pause and switch headsets and be back with you in just one moment.
Sounds good. Thanks, Stephen. We can actually go ahead and launch the first polling question really quick. And as we mentioned before, If you would like to receive CPE for today, you have to respond to 5 of the 6 separate prompts. So this very first one is nice and simple. Would you like to receive CPE for today? So go ahead and just lock in your answers there. While we're doing that, just a quick reminder, we do have our next webinar in the series coming up January 19th, 2021. Can't believe I'm even saying that year already. And Stephen and I were just laughing at 19, 20, 21. So a nice little sequence to remember for all of you dedicated fans out there. We're going to go ahead, like I said, just keep this CP up for a little bit here. Make sure that everyone can lock in their answers.
All right, Sam, quick mic check on the new audio connection.
You sound wonderful and ready to go. So thanks, everyone.
My apologies for that, but it's good to have backups. So to recap, the GASB has issued guidance that is not so much new guidance as an explanation or a roadmap to old rules that already existed, but maybe will be applied in a new context due to the pandemic. On May 8, as things continue to progress, the GASB issued an actual standard, statement number 95, that postponed the effective date of virtually every standard that was not yet effective as of that date. That impacted everything from asset retirement obligations that were right on the cusp of being implemented with GASB 83 to very large projects like GASB 84 on fiduciary activities and GASB 87 on leases. Smaller projects like debt disclosures and accounting for interest during the construction cost, and then a variety of standards that weren't on the radar to be implemented anytime soon. We already had a fair amount of time for GASBs 90 through 93, but those were all updated as well as the related implementation guides. In general, everything got pushed back a year with the exception of the lease standard, which was pushed back 18 months. But before you get too excited about getting a year and a half of extra time, the way fiscal years work, you either get 1 year or you get 2. Nobody gets an 18-month reprieve on leases. So for some people, it made no difference at all. For others, it was a 2-year extension, depending on where your fiscal year fell in that mix. And then by the end of June, the GASB had followed up one more time by issuing Technical Bulletin 2020-1, and that is accounting and financial reporting issues related to the CARES Act and coronavirus diseases in general. Now, if that title scares you, coronavirus diseases in general, like there are other ones, unfortunately there are, and that actually surprisingly bears into the GASB's judgment on a couple of issues that we'll talk about when we get to that. We've already grabbed our first CPE prompt, so we're going to go ahead and dive now into the accounting for pandemics section of our presentation today. So the GASB's Emergency Toolbox is a free resource that's available on the GASB's website. And all you need to do is go to gasb.org, and then you can click in the search box for emergency, and that will take you to the toolbox. Unfortunately, the web address is long and complicated and didn't lend itself easily to being in a bullet point here. But it's been updated since it was originally issued. So if you've been out there, and not recently, it's good to know we're now up to 26 different issues that have been identified, elements of governmental GAAP that may be relevant in a pandemic situation. All of these are not going to be references to individual GASB pronouncements, but rather references to the GASB codification. So before we dive into the specific guidance the GASB has highlighted in the toolbox, let's take a minute to talk about what the GASB codification is and what you can do to reference it, since that's going to be important the way they've structured things here. So the GASB has issued, at the time that this slide was drafted, over 95 separate statements. And we've actually seen that go up since then, plus a lot of interpretations, implementation guides. And the GASB's practice is different than we have seen with some other professional standard setters. When the GASB amends a standard, it does not go back and actually change the original statement that was issued. So even though GASB 14, which sets the rules for determining what is a component unit and what goes into a primary government or a reporting entity, has been amended multiple times. There are at least 4 standards that have spoken to it significantly, and a few omnibus standards. It's been amended over and over and over again. But if you go to the GASB's website right now, you can still pull up GASB Statement 14 as it was originally issued 30 years ago. Not terribly useful. So with those original statements not being updated, old standards are not a great place to go. A standard that is brand new and hasn't even been implemented yet is usually fair game, but even there, the GASB has been known to amend standards after they're issued but before they're effective. And so looking at original standards, while convenient, while we sometimes refer to guidance based on the statement that it came out with, it can be dangerous to make sure you've got a complete picture. In addition, the AICPA and FASB have issued various guidance that the GASB said, we want to take credit for that too. And so they've adopted various AICPA standards, accounting guide references, and older FASB standards. So really the only place to go for complete, up-to-date, all-inclusive information on what are the rules for governmental accounting is the GASB codification. So it's probably worth knowing what it is and where to find it. Well, GASB's codification is organized into 5 different parts. And these parts are helpful if you're going into the codification and looking for an answer. So part 1 for general principles lays out kind of the basic foundational elements of governmental accounting. Part 2 on financial reporting focuses on what goes into the actual statements. So think part 1 is debits and credits, part 2 are the statements, but they both kind of bleed into each other a little bit. Part 3 is a relatively short part and it focuses on fair value measurements. And then part 4 is all about the unique specific accounting for certain types of transactions. For example, if you want to know something about accounts receivable, you'll find accounts receivable specific guidance in part 4. Part 5, standalone reporting, is for special purpose governments. If you're looking at the financial statements of a pension plan, not how does the government account for its pension, but the standalone financial statements of a pension plan itself, part 5 is your place to go. Then within all of the various parts and all the sections inside the codification, the paragraph numbers are organized in a consistent way. So if you see a paragraph reference between 101 and 499, that's going to be category A applicable GAAP. Those are the rules. So if there's a reference to GASB codification section 1600 paragraph 138, you know that's the standard related to a particular area. The 500s are used for the glossary. Those are definitions that are authoritative. And then parts 600 through 800 are set aside for category B GAAP, things that are still authoritative, but go through a lower level of due process. So the technical bulletins, implementation guides, and literature written by the AICPA, but cleared by the GASB, all fall into that. If you're seeing something in the 900s, that's going to be non-authoritative. It's going to be examples, it's going to be illustrations, but it's not technically GAAP. We certainly want to look to those for ideas, but it's not level A or level B at that point. Now, if you want to look up the GASB codification for yourself, the place to do that is the Governmental Accounting Research System, or the GARS. That's published by the GASB for free. It's available at gars.gasb.org. And the Governmental Accounting Research System is basically all of the original pronouncements and the codification and the implementation guides and an index where you can look up things by topic alphabetically and it will reference you to the proper section. So if you're interested in looking at the answers for yourself, rather than going to a bookshelf, which right now might be difficult for many of us if you have your original pronouncements, if you're a paper person and have those sitting on a bookshelf back at the office and you're working from home, that can be a challenge. But even if it's downloading PDFs of those, your best bet is to go to the GARS and be able to look these things up yourself. And the way you can do that is by logging into that website. When you go here, you're going to find, first it's going to ask you to check a box saying you're not a robot. It's otherwise free. You can get in and take a look at things. Now, these screenshots are actually out of date. This is talking about a 2014 release, but the interface really hasn't changed significantly since this time. So it's a very handy option to be able to go in and look at things a variety of different ways. So here's one view where we've actually gone in to the original pronouncement, GASB 34, and so we've looked at original GASB pronouncements, GASB 34, and are looking specifically at paragraph 11. Paragraph 11 was one of those examples, like I talked about earlier, where the GASB issued a standard, and before it even became effective, they had already amended it. GASB 37 had to amend paragraph 11 of GASB 34. So in the GARS, we can see paragraph 11 is highlighted gray. If you just pick up a copy of GASB 34 off the shelf, and For those of you who think only accounting nerds do that, there are a few accounting nerds on this call, and I know a few of you who do have a hard copy of GASB 34 on your shelf. No judgment here, that's great. I have a blue book within close range of me at my home office. Paragraph 11 has been changed, and you won't see that in a paper book because at the time it was published, that was GAAP. But this will warn you before you rely on that particular paragraph, realize that what you're working with is out of date. Now, the little blue diamond next to that, it's an indication that if you click there, it would actually take you to the standard where it got amended. In this case, we're now in GASB 37, which was the amendment to GASB 34 that came out very quickly. And you can see there's a reference here that the introductory sentences preceding subparagraph A and paragraph 11 of GASB 34 is replaced with the following. So here is the replacement language. Unfortunately, that's not a complete picture. GASB 34 has most of the text. GASB 37 had a little bit that was replaced. Where do I go to just see it with all the changes integrated? Fortunately, that's what our last option is, the codification. And the place it ended up in this case is Codification section 2200, paragraph 109. Now, the numbering doesn't bear any relation to the original paragraph numbers of either GASB 34 or GASB 37 that amended it. But 2200 tells us that we're in the 2000s, so that's reporting. It's focusing on how the statements look. 2200 is the portion of reporting that focuses on the CAFR, the Comprehensive Annual Financial Report. And paragraph 109 is what brought its guidance in from GASB 34. And what we see here now is the amended language in place as it was originally written, plus the amendments all together in one spot. So really, if you were looking for what does GAAP say about what belongs in management's discussion and analysis, you wouldn't get a complete answer anywhere other than coming to the codification. So all that to say, we're about to walk through some references from the GASB's emergency toolbox, and all of them are going to be written in with the format of codification. So I wanted you to be aware of that. The GARS is available with 3 different views. The basic view is free. I find it sufficient for almost everything I do, so I have the free view for myself. The academic view, if you're a professor, then you can get a free upgrade to the professional version. If you're a college student and are getting that deep into GASBs, you can do that too. But the academic view gives you free access to professional. There is a subscription-based version that allows better text searching, and that's certainly an option. But the topical index is pretty good, and it'll get you most of the data you need. We don't get any kind of a spiff off this, but just in case you're interested, you can go to gars.gasb.org and buy your own subscription if that's something you feel you need above and beyond the basic view. All right, so let's hop into some of the items from GASB's emergency toolbox. And essentially, all of these are going to follow this same format. The GASB identified a topic, in this case, capital asset impairment. Then they give us a bullet point of an example of when this might be relevant. So in this case, capital asset impairment might come up because of discontinued operations that are other than temporary or idle impaired capital assets. And if you're interested in knowing what to do about that, you can go to GASB Codification section 1400. The 1000s tells us it's related to accounting, the debits and credits. 1400 is the section on capital assets, and the paragraph references are 176 to 180. Now, we're not going to go through all 26 items in the toolbox in great detail, but there's a few of them that I think are a little more likely to come up and be important than others. So I thought I'd highlight a few of them. And this is a good one to start with. Capital asset impairment, that standard was really written from the perspective of physical damage. So if you have tornado or hurricane damage that comes through and has physical structural damage to the roof of a building, there's GAAP on what to do with that. There's also GAAP on what to do with construction stoppages. Now, if they're permanent, if you're like abandoning a project, you've got historical cost in there that was intended to benefit future periods. If you're not going to finish construction, you're never going to have future periods that benefit from those dollars. And so it doesn't really make sense to capitalize them anymore. It's going to need to be impaired, written down to its realizable value. My guess, and it is just a guess, is that COVID-19 has probably not resulted in very many permanent construction stoppages. However, COVID-19 may have impacted some government's ability to continue certain operations. And there may be a permanent discontinuation of operations. And if so, we may have assets that are no longer going to be used in operations, and we have to go through the math from what it was originally GASB 42, but is now Codification Section 1400. So if that's your situation, that's the place you'll go in Government GAAP to determine how much of an impairment loss needs to be recognized. The next item in the toolkit is contingencies. And there were two different issues the GASB wanted to highlight here. One is risk financing and insurance-related activities. And that would be if a government is self-insuring or is serving as an insurance entity to others, there may be claims under COVID-19 related matters. Maybe there's some sort of business interruption insurance. Maybe there's some kind of demand on health resources. If you have self-insured for health insurance and people are getting sick and requiring expensive treatment or ventilators, there could be issues there. And so GASB Codification Section C50, which talks about claims, is going to be the relevant source of GAAP for that. And there's a good chunk of paragraphs there to focus on it. The other thing could be contingent liabilities, which are very different than insurance issues. This would include exchange financial guarantees and contingent assets, times where a government is on the hook contingent to something else happening. And if there is some sort of guarantee where one government has stood up for another, and there is now some kind of contingent liability that is relevant because of another government's inability to pay, especially given declines in tax revenues and things that were impacted by stay-at-home orders, that could be relevant GAAP for you as well. Debt extinguishments is the section of GAAP from section D20 of the codification that talks about what to do when you're having debt forgiven or written off. This can be relevant, especially for nonprofit component units of governments that are dealing with the Paycheck Protection Program. Most traditional governments were not eligible to participate in the PPP, but some governmental entities did fit the definition because they were also organized as nonprofit organizations and might qualify. The GASB, we'll talk about this later, has actually provided some guidance on what to do if loans are written off or forgiven. In addition to the PPP, there might be other federal grant programs that are styled as loans with certain forgivable purposes. And so there's GAAP that addresses what to do when debt is being extinguished or written off, or if a government is finding itself in troubled debt restructuring land because revenues have been so impacted by the pandemic that they find themselves unable to make their own payments, and there's a need to restructure or refinance existing debt in order to keep up with those payment schedules. Demand bonds would be that kind of liability that could be converted from long-term debt to short-term debt. They could become due upon demand. If demand bonds have been remarketed or a counterparty is executing a takeout agreement, governments might find themselves needing to account for that transaction. Codification Section D30 will walk you through the relevant GAAP for that. We historically talk about derivatives mostly from the perspective of investments. Derivatives are sort of a way of having a very highly leveraged investment portfolio where a small amount of money can have very significant returns. But there's also derivatives that are being used to hedge against price fluctuations, where a derivative is actually designed to provide a counterbalance to volatility in the market. Well, when Codification Section D40, Derivative Instruments, talks about dealing with hedge accounting, it basically smooths out the income statement impact. It allows those derivatives to have their value offset with deferred inflows of resources and deferred outflows of resources. But there can be times when hedge accounting has to end, and that can be caused by significant changes in the market, circumstances where a swap counterparty or its credit support provider has an act of default or termination, and all the things happening in the economy could trigger some of those transactions that frankly are normally very unusual. But if you have hedged derivatives, well, first of all, if you're scratching your head saying, what is a hedged derivative? The good news is you don't have any. You'd know if you did. For those of you who do have them, if you're wondering, what do I do in this situation? I never thought this would happen. Codification Section D40 is going to be your go-to place. Let's pause here and take our second CPE prompt. Our next area is disclosures related to outflows of resources. So this is a recent addition. This was added just in the last few weeks by the GASB. And the focus here would be outflows of resources that are incurred in response to COVID-19. There are disclosure requirements found in Codification Section 2300, which lays out what belongs in the notes. And there's a lot that goes in the notes. So you guys understand that the notes to a set of government financial statements can sometimes read like a phone book. There's an awful lot there. Well, there's a provision in paragraph 108 that would talk about when would you need to have a disclosure about significant unusual outlays. And COVID-19 might be that situation for some governments. If there are very significant amounts of costs being incurred related to something COVID-19. We did have a question come in about the CP attendance prompts. Those should be pop-up windows that appear inside Zoom that you can answer as polling questions. There's no actual text on the slide other than just a reminder for us to put that up on the screen for you. So hopefully that works for everybody. For disposals of operations, there is a provision in GAAP for what to do if a government had a particular service line, a particular activity that it's getting rid of. That can happen through a transfer to another government or another entity or an outright sale. Codification Section CO10 on combinations and disposals of operations addresses this. When you see a codification section with a capital letter and a lowercase letter, that tells you it's in that last section, Section 5. So the 1000s and 2000s and 3000s are kind of their own sections. The single letter is going to be our types of certain balance sheet and operating statement items, and then the double letters like this are going to be the standalone accounting or specialized accounting issues. So disposals of operations, as you can imagine, isn't the sort of thing that comes up on a day-to-day basis. Governments certainly do discontinue certain programs, but not on a routine basis. So when that happens, especially if it happens as a result of difficult budget cuts during a COVID-19 budget adjustment, this would be your place to go to, the CO10, in order to find out how do I account for shutting down an entire program that the government's operating. Donated inventory is one of the new additions to this section of the GASB toolbox, and it's in response to all of the donation of personal protection equipment the governments have been receiving. We've seen federal agencies providing PPE. We've seen local organizations collecting, having volunteers prepare and sew together masks or provide things to government. And there's a section in Governmental GAAP, it's in Codification Section N30 on non-exchange transactions, that addresses how to value those at the time the donations are received. I will tell you at the federal level, right now, we're not getting a lot of help from the feds in terms of valuing personal protective equipment that has been provided by the federal government. They may provide a ventilator and still not tell you what the cost was. And the latest that we've heard, working on a subcommittee of the AICPA talking to the feds, was governments know what these things are worth. They'll be able to value it. Well, that's great for a single audit, I suppose. It also becomes great for GAAP because to the extent we've received donated inventory, Codification Section N30 will walk you through valuing it and recording that and indicating when, timing-wise, should that hit your books. Extraordinary and special items is something that a lot of people would have expected to turn to. And at the time the GASB's emergency toolbox came out, I think a lot of folks were expecting that COVID-19 or the economic impact of the stay-at-home orders or something along those lines would meet the definition of extraordinary and special items. Subsequent to the release of the toolbox, we actually have the technical bulletin that addresses this question directly. So I'm going to put a pin in this for now and come back to it in a little bit. But recognize that there is GAAP that addresses when can something be considered extraordinary and when can it be considered special. And spoiler alert, the answer is not what you think. Fair value measurement, this is the only thing that's in Section 3000, so Section 3100 on fair value measurement of the codification addresses how to value various investments. But the underlying premise for governments evaluating their investments is that this is what it would cost, this is what they'd be able to sell an investment for on an open market that's being done in an orderly manner. That it's not a fire sale. There's not a rush to get bargain basement prices. This is really what an investment is truly worth. Well, when the market is going through the kind of volatility we're seeing now in response to the pandemic, we may not meet the definition of the market in an orderly transaction. And if that's the case, it impacts how we go about valuing our investments. It may actually save you from having to have a huge write-down on an investment when the current pricing is based on very unorderly market conditions that we hope will return to normal soon. Going concern is not something that frequently comes up as a major issue for government. There have been exceptions, but as a general rule, governments don't go out of business. One column may run out of money. One fund may run out of resources. A government may have a deficit in part of its operations, but as a rule, governments tend to kind of keep going in perpetuity. However, there is still a provision in Governmental GAAP for what to do when there's information that contradicts the normal presumption that a government is going to continue forever. From an accounting perspective, there's an awful lot that doesn't work anymore if we don't assume a government's going to be there forever. Think about depreciation. I purchased this asset. I expect it to benefit me for the next 40 years. I'm going to depreciate it over those 40 years, not because it's going down in value, but because I'm spreading the cost, spreading the benefit over the years that benefited from it. And now all of a sudden we're saying, I don't know if we'll still be in business 5 years from now. Does it make sense to spread the value of an asset over 40 years if you're not going to get the benefit from it? This is why it becomes very important for governments to consider whether going concern issues exist for them. And when they do, Codification Section 2250 has additional financial reporting considerations. What are the underlying conditions? What are management's plans? And then there are also auditing implications for auditors to respond to all of that. There is a provision in GAAP in Section CO10 on combinations and disposals about what to do when two governments combine, a merger, one government either acquiring another or transferring operations or just merging together and becoming one. We may, and this is just speculation, we may see more of this during a pandemic when governments are finding their revenues being strapped, tax bases being impacted. There may be a desire to combine similar operations in close geographic proximity to reduce administrative burden and structure. And if so, there's a place in Governmental GAAP on what to do. How do you take which values and pull them together in order to account for that kind of combination? Management's discussion and analysis was what we were talking about earlier with those paragraphs of GASB 34 that were amended. There are requirements from Codification Section 2200 on the CAFR that talk about currently known facts, decisions, or conditions that are expected to have a significant effect on the balance sheet, financial position, or the income statement, results of operations. So there's already a section in MD&A that is dedicated to what has already happened that we know about that we think will probably impact future financial statements. Well, if COVID-19 doesn't fit that definition, I don't know what does. For governments who are issuing their MD&A, there are a lot of currently known facts. We don't know for sure what's going to happen tomorrow or next month or next year, but we do know what's happened already. There are things that are already afoot that we're aware of, and some decisions may already have been made. Next year's budget may have been adopted. State shared revenues, payment schedules may have been announced formally. It's not conjecture, it's been passed, it's a law, we know what's coming. Those conditions may have a huge impact on future operating cycles. And while we're not supposed to try to predict the future, we are supposed to describe the things we know about today that we think might help form that future. Non-financial or non-exchange financial guarantees are where one government is guaranteeing the debt of another. In my home state of Michigan, we see this with county governments guaranteeing the debt of townships quite frequently. So what do you do if the grantor, that's the grantor of a guarantee, so in my example, a county, when should they recognize and what should they disclose if a government is more likely than not unable to make a payment? So the township is responsible for making the debt payment. The county has guaranteed it. The township's tax base is eroded. Transactions aren't there. They're not getting state shared revenue because property tax or sales taxes have fallen down. And so they're saying, what do we do now that it looks like this entity that we guaranteed is not going to make good on their payment? Codification section N30 is going to tell you what to do there. Also, governments that have outstanding obligations that have been guaranteed by another entity need to be disclosed. So if we do have an entity that is a recipient of a Paycheck Protection Program loan, that is a guaranteed loan by the Federal Small Business Administration. And so there are disclosures related to that. I know that's not the norm for most governments, but it is something to be aware of. If you have a loan from the SBA of another type, economic injury disaster loan or some other loan that's federally guaranteed, there are disclosures that come along. Non-exchange transactions. This was a new addition to the GASB's emergency toolbox recently. They said, what happens if there is subsequent contravention of eligibility requirements? Or in English, what happens if there is a grant that said you have to do certain things in order to earn the grant, and because of the pandemic, the grantor agency decides to be a little more forgiving? We saw that with a lot of federal grants that said, you know, we understand that workers who would normally be spending their time carrying out grant administration activities are at home during a stay-at-home or shelter-in-place order. And while that's the case, we're giving permission to charge their time to the grant anyway. That was very unusual. As little as I like the word unprecedented, there's a good use for it there, because for the feds to say, please charge money to our grant, even though the folks aren't working on it, was very, very different. Well, that was an eligibility requirement that was contravened. The feds loosened the rules and said you can do something. So that impacts the timing of revenue recognition, and codification section N50 walks us through that. There are also whole sections on operating and non-operating revenue and expenses. So the classification of certain transactions that are not addressed between category A or category B literature, and what are we going to do there? There are types of transactions related to the pandemic that simply weren't thought through. They're not on the list of sample things of, well, this is operating, this is non-operating. In the absence of those clear definitions, new types of transactions happening for the first time, go to Codification Section 1000, which is the hierarchy of GAAP, and just look at the conceptual framework, and Section 2200, which is the CAFR, and look at what they offer as guidance, and then make some informed judgments. Not new GAAP, just a new application of GAAP in a very unusual world. Prior period adjustments and accounting changes. We may have governments that are needing to go back and adjust the past. And reasons for that can include things like a change in accounting principle, accounting estimate, especially estimates where things that have made sense in the past no longer do because of a changing environment. Or we may even have changes in the reporting entity because of shifts in organizational structure, component unit status changing as a result of the pandemic, the inability for certain criteria that have historically been the basis for those components to be included to continue. So Codification Section 2250 picks up a whole miscellany of topics related to how to account for things like that. That's a good place to go for it. Property tax revenues are covered in Codification Section P70. And as a general rule, property taxes can only be recognized in fund financial statements if they are collected soon enough after year end to be used for paying bills of that period. And the GASB has put a specific clock on it. This is the one example in GAAP where the GASB has said 60 days is the maximum. Governments may choose a shorter period of availability for property taxes or a different period of availability for other types of revenue. But property taxes is the one place that the government or that the GASB has said, no, 60 days is really it. But they built in a very interesting provision that was never meant to be abused, but may need to be exercised at this time. And that is, what happens if property taxes are usually year in, year out collected within 60 days of year end. But this last year, because of a stay-at-home order, something during the pandemic, property taxes didn't get collected until 80 days after year end or 90 days after year end. Despite being past the GASB's normal hard and fast rule, this provision in GAAP says if they are normally collected before, and by normally we mean normally for you, not normally for governments in general, then this one-time exception would not prevent you from recognizing the revenue. That's important gap. You'll want to know that, and it's found in section P70. If you are a public entity risk pool, meaning an insurance company that is also a government, there are a whole bunch of considerations that this pandemic may trigger in terms of whether there are claims that need to be exercised, etc. Codification section P020 is going to be your go-to place for literature. There's a lot of great stuff there. Let's pause here and do our third CPE prompt. You should have a poll popping up asking if you're coming to our next webinar. And we were just musing before this webinar got going that if you read that date out loud, our next webinar is January 19, 2021. It sounds like we're counting right up, so kind of a cool date. Hopefully you can join us on January 19, 2021. The next area in the emergency toolbox relates to revenue recognition, and there's a lot of places to go for this. So certain actions that provide budgetary relief, like accelerating the receipt of future period revenues, do not result in a comparable change to accrual-based and modified-based inflows and outflows. What does that mean? Governments that are cash-strapped look to creative ways to get money in to balance the budget. And one of the creative ways that we've seen governments do that is by selling future revenues. It's sort of the inverse of the old Popeye line, I'd gladly give you $1 tomorrow for a hamburger today. This is, I'll gladly give you $1 today in exchange for all the revenue that you would have collected 2, 3, 4, 5 years from now. Realize that there are places in governmental GAAP that specifically relate and speak to what to do in those scenarios, what to do if there are changes in property taxes. The more creative governments try to get in selling future revenues or receivables or taking anticipation notes on property taxes or anything else, all of those are great from a cash flow perspective, and the GASB is not trying to dissuade you from thinking outside the box. What they are trying to do is tell you how to account for it, and these references will do that for you. On the expense side, there are certain actions that provide budgetary relief on that side, like not paying certain bills right away that are already incurred, but that also should not impact when we record expenses or expenditures. So the fact that money is tight right now and I decide, you know what, we're gonna wait and not pay some of our bills for a month. We're gonna have a payment holiday where we're not paying our employees for a time because we're out of cash. I don't love that answer. I'm sure you don't love that answer either. But if you do it, recognize GAAP does speak to when do you need to book things, what liabilities need to go on the books, and these codification section references will walk you through that. Estimates for uncollectible amounts, especially governments in the utility arena. There are a lot of our citizens, our constituents, who were economically impacted by the stay-at-home orders. Some people were unable to work, and unemployment benefits or other options just did not make up enough of the gap for them. Some of our constituents may have been sick and unable to work. Some may have been laid off permanently or temporarily. And because of that, there's a lot of receivables. Think utility billings for water and sewer or other things like that that may be questionable. So there is GAAP that walks us through what do you do if property taxes are now not collectible, if utility bills, utility receivables are no longer collectible. What if a government has been a lender under an economic development initiative and now the businesses involved who owed money back find themselves insolvent? COVID-19 shut them down. All of those considerations are found and available here. We've already alluded to sales and pledges of receivables and future revenue. Here's the codification section in S20 that addresses those. And significant violations of legal or contractual provisions. This becomes relevant for the first time because we may have bond covenants or certain agreements where we've said we're going to maintain certain debt ratios. We're not going to have more liabilities as a percentage of our overall budget than something else. And the pandemic may have had a significant financial impact. The ability to pay debt, the ratios, the things that are based on could all be impacted. So codifications sections 1200 and 2300 are going to address what to do when a government has significant violations of either legal provisions or contract provisions, where to disclose it, what to do about that. Subsequent events was a huge issue for calendar year-end entities, and still a relatively big issue for March 31st year-ends. We're now kind of into a season where a lot of June 30 year-ends have closed and are currently going through audit prep year-end close procedures and getting their financial statements ready. Well, the subsequent event disclosure requirements, events or transactions that impact the financial statements that happen after year-end, becomes a little more nuanced. June 30, for example, was well after the pandemic had started, but still there have been things that have happened since then. In my home state of Michigan, we had the Michigan State Legislature passing significant funding through to local units, colleges and universities, effective in July of 2020. Well, as helpful as that is, and as necessary as that was, it was a subsequent event to any June 30 year end, and impacts the timing of revenue recognition and the disclosure of material subsequent events. So disclosure for new legislation that was enacted after the end of the reporting period, that's when coronavirus relief funds were released in the state of Michigan for a number of entities. Codification section 2250, which is that miscellany of topics, addresses that for you. Here is an example subsequent event disclosure that we have used at Raymond for some of our clients. And it just points out that the event, this was for a calendar year end, the event, it happened in March. That's when COVID-19 was declared to be a pandemic. Ultimate impact is unknowable at this point. It could put demands on the county, in this case it was a county government, for providing emergency services. We reasonably expect that it will have a negative impact. We don't know how big it is, and so there's nothing to book at this point. That's the kind of type 2 subsequent event where it's a known event but not a bookable event is likely to come up. If you're a junior end, some of these disclosures may still be relevant, but they may no longer be subsequent events. They may just simply be no disclosure for things that were already in place as of year end. Termination benefits in section T25 of the codification focuses on early retirement incentives, severance packages, things like that. Now, if you have a one-off severance package, the likelihood is it's not material. But if a government had to make significant layoffs, staffing reductions, or offered a significant early retirement incentive in order to reduce the workforce and save money, you may need to go to section T25 to find the details on how to account for that. The short answer is net present value of future expected cash flows to be paid out there. Troubled debt restructuring, we've already kind of alluded to earlier, but if a government is either the debtor or the creditor, and there is a situation where the debt can't be paid, codification section D20 addresses how to account for the restructuring, the renegotiation of those kinds of debt agreements. At the end of the GASB's emergency toolbox, then, they provide a series of links. They say these are links to other professional organizations that are offering advice on how to proceed, but they also say the GASB only issues guidance after extensive due process, so these links are not an endorsement. They are helpful, though, so I would encourage you to check out the GASB's emergency toolbox, take a look at the outside links. It's all useful information and getting us looking the right direction. So let's switch gears from the toolbox, which really didn't issue new GAAP, but just told us how to apply old GAAP, to GASB Technical Bulletin 2020-1, which is issuing new Level B GAAP. And it did it in a question and answer format. So very briefly, let's walk through each of the major sections of that guidance and what they were addressing. So the first item on here is related to the Coronavirus Relief Fund, which is a portion of the larger CARES Act. So it says Coronavirus Relief Fund payments are characterized by GAAP as voluntary non-exchange transactions. Well, once we know that they meet the definition of a voluntary non-exchange transaction, that helps us decide where to go in terms of how to account for them. Voluntary means you have the option to apply for the funds. It wouldn't have made any difference from an accounting perspective if they were government mandated non-exchange transactions. And it tells us that we should recognize the revenue for them as soon as the eligibility requirements are met. So in the case of Coronavirus Relief Fund, the eligibility requirement would be incurring eligible costs. And of course, there's a whole litany of things Basically costs for responding to the pandemic, costs that were not included in the last budget that was approved as of a date back in March of 2020, a whole lot of specific things, and Treasury continues to put out new guidance all the time. The U.S. Department of Treasury issued updated frequently asked questions on the Coronavirus Relief Fund last night from the day that we're recording this, and it continues to be an ongoing, evolving thing. The second question talks about the Provider Relief Fund, which focused mostly on hospitals and medical practices. And it indicated that the loss of revenue is an eligibility requirement. So the Provider Relief Fund was different from the Coronavirus Relief Fund in that it actually allowed recipients to use a portion of the grant to cover lost revenues. All the governments who are on CRF funding are understandably groaning right now because that's been the biggest complaint from local governments. It's not that COVID-19 was so expensive, it's that our revenues dried up. And finding eligible expenses is all well and good, but boy, it would be great if we could just keep it and use it as revenue replacement. Well, the Provider Relief Fund allowed that, and the GASB has said accordingly, if you calculate lost revenue under that grant using its definition, that would meet the requirement of an eligibility requirement for revenue recognition. The third item in the technical bulletin says if there are any changes to the CARES Act after year end, they should be disclosed, but not recognized. Now that's a tough pill to swallow. So if the CARES Act is amended and says, you know what, we're going to give you more flexibility, we're going to allow you to do certain things, the fact that that flexibility didn't exist as of the last day of your fiscal year means you cannot recognize things retroactively. So any further movement, any relaxation of rules, any kind of changes is a non-recognized subsequent event, which means governments may still get the relief, but have to defer recognizing that until a subsequent accounting period. Not the answer some people expected, but it's where the GASB landed. Speaking of places that we didn't expect to land, the GASB has taken a completely opposite approach to the FASB and AICPA on accounting for Paycheck Protection Program loans. I indicated that most governments aren't eligible for these, but there are a handful of entities that are nonprofits that are also roped into Governmental GAAP. And the GASB's take is a PPP forgivable loan is a loan. Even though you may expect it's going to eventually become a grant, even though that was the expectation when you signed up for it, because it's styled as a loan, they say it needs to stay a liability until formal loan forgiveness, the legal release from the debt has been received from the SBA. Well, the last time I checked, and it has admittedly been a few days, but the last time I checked, the SBA had formally gone through and approved exactly 0 loan forgiveness applications. They hadn't denied them either. They just were so backlogged, they hadn't done any of those. So that can be a real challenge for governments. On the FASB side, nonprofit organizations have been told by the FASB that if you believe in good faith that you went after this PPP loan fully expecting it to be forgiven and that you believe you have met the criteria, despite the fact legal loan forgiveness hasn't happened yet, you can go ahead and book revenue. Well, that's great for FASB. GASB went the other direction and they said, no, wait for legal release. Business type activities should account for CARES Act money as non-operating revenues or non-capital financing activities on the statement of cash flows. So we're at least told where to put the CARES Act money. And then question 6 was another head scratcher. The GASB said, we don't believe COVID-19 costs meet the definition of an extraordinary item. In order to be an extraordinary item, it has to be both significant and unusual and outside of the control of management. Well, clearly, COVID-19 was not within the control of management, but is it significant in nature? Yes, it was a huge. Is it unusual and infrequent in occurrence? And this is where the GASB said, you know what? Coronavirus diseases happen all the time. COVID-19 is the specific one we're dealing with right now, but that kind of virus, a coronavirus, is not new. This isn't the first, it won't be the last. Therefore, they say this doesn't meet the definition of extraordinary. And clearly, it's not within the control of management. It's a medical condition. So they've said no to characterizing any of the impact of lost revenue, any of the incremental costs incurred. None of it can be shown as either an extraordinary item or a significant or a special item, I should say. So one compromise solution, if the government has incurred significant amounts of costs related to COVID-19 and it wants to show them separately on the financial statements, there's nothing preventing you from having a line item as a function called pandemic response or something. It won't be an extraordinary or special item down below the line, but at least it could still be highlighted on the financials, and that would be perfectly fine. Let's take a moment for our fourth CPE prompt. We have been doing these AGA West Michigan webinars now for just about 10 years. We have used a number of different formats and platforms, and Zoom is the one we're using today. We'd love to hear your feedback on Zoom as a platform for these webinars. And with that, we are going to switch gears from accounting for a pandemic and talk for a little bit about auditing. So for all of you who are auditors, either working for a CPA firm or a government audit agency, this is for you. For all the auditees, listen in for a behind-the-scenes analysis of what the auditors are thinking about. So this is going to be a hodgepodge of topics that are relevant to auditors. And the first one is the concept of remote fieldwork. So how an auditor goes about obtaining information will significantly impact how well and how smoothly an audit ends up running. And there's a lot of different options available to us. Auditors may have information emailed to them, either a regular unsecured email or through some kind of a secure email platform. And obviously with much of what governments do, Freedom of Information Act applies, and privacy is an issue, but not as much of an issue depending on the document. So perhaps for certain types of transactions, certain types of information, it's acceptable for email to be the way we're getting things. A number of firms, even before the pandemic, were set up for a file sharing service. And the file sharing service would be a great way to upload documents. Maybe it's something that the auditors actually have a license for, maybe something that the government uses, and that could be something like Box or Dropbox or Google Drive, a number of different ways to do that. Some of the firms actually have a dedicated portal, a place that you can upload and download information securely. Some of the better portals are even organized so that you can lay out all the different audit areas and keep track of what's been uploaded and what hasn't, and whether it's been reviewed, that sort of thing. And then finally, we're actually seeing in some cases governments that maybe don't have their records as digitized as others, arranging for some kind of a drop-off of information to their auditors, or the auditors swinging by and picking up a box of information. And what we've seen in practice here was really varied based on two factors: the firm's ability to work remotely with technology and the government's ability to produce information electronically. During the height of the stay-at-home orders, when many governments had virtually no one working on site, a lot of the work was almost at a standstill, except for those governments who already had very digital processes. So I have some government clients who already had all of their invoices digitized and have all their processes were done that way. And the concept of getting information electronically could be done from home as easily as it could be done anywhere else. Other governments, the way they got stuff to the auditors was being in the office where physical files were pulled out of a drawer and run through a photocopier that emailed it to the auditor's address, or emailed it to the government employee who forwarded it to the auditor. Without access to that hardware, you run into some real challenges. So all of these solutions have some merit. Whether we're able to use all of them or a combination of them is fine. With changes here in Michigan, from executive orders to orders from the Michigan Department of Health and Human Services and impacting remote work, the concept of drop-off and pickup and trying to minimize human-to-human contact is certainly appealing, but all of this impacts efficiency. We think about all of this and how much can we get done remotely, how much can we handle is very much going to depend on how digital we are. Governments that have cloud-based accounting systems are finding that their accounting staff are better equipped to work from home. Even if they have desktops at the office, a home computer can connect and they can still get work done because it's cloud-based. If they have dedicated installed software and non-mobile computers, that really challenged them to get things done. So I think one of the takeaways, it's not really auditing specific, but one of the takeaways from the pandemic is a lot of governments will be critically evaluating how to structure things so the next time something unexpected happens, whether it's medical related or whether it's a natural disaster or whatever it is, we'll be better equipped to pick up and keep working in a different manner. For auditors who are then communicating with their clients, getting information, documents is one thing, but actually having dialogue with clients is quite another. And the three primary methods that we're seeing in practice, this is not new, but email continues to be a significant way that auditors and auditees can stay in touch. An auditor can organize a question, put it well in writing, the client can respond at their convenience, they can give a well-reasoned and ordered response, and we have a pretty good idea that the answer that was typed will be the answer that was received. Maybe we don't have anything lost in the translation of a verbal message. Telephone still works and people can pick up the phone and talk, but that is being slowly supplanted by platforms like the webinar that we're using today. Things like Zoom or Skype or Microsoft Teams or Google Hangouts, maybe called Google Meetings now. They've renamed that recently. Lots of different options for people to be able to have essentially face-to-face meetings through video conferencing. Something that was science fiction only a few decades ago is now so ubiquitous we're all very used to it. So each of these methods has its advantages and disadvantages. We talked about how email is great because it gives you a clear paper trail. It's not dependent on someone being available this exact moment. If a dog starts barking in the background, if someone's got a kid who's homeschooling and needs their attention, they can still give a reasoned response without being tied to something immediate. But email has its downsides, same as text messaging. And you've probably been wondering what this strange little icon here is about, I did not say he kicked his dog. This is a seemingly neutral statement that I wanted to use as a way of demonstrating that written communication can sometimes be either completely lacking in context or possibly very easily misunderstood. So let's take a look at this statement. The words are, I did not say he kicked his dog. Clear, concise, simple written statement. But think about all the different ways that you might interpret that by putting the emphasis during the reading. What if we said, I did not say he kicked his dog? Well, suddenly this sentence is not a neutral statement of fact. Now it's, well, he definitely kicked his dog. I'm just not the one who said it. You didn't hear it from me. If someone reads that same simple neutral statement with a different emphasis, and now it says, I did not say he kicked his dog, suddenly the sentence means, well, he totally kicked a bit. I'm not the one who was going to be sharing that information. If we say, I did not say he kicked his dog, suddenly the sentence means that dog totally got kicked, but it just wasn't by him. There was another perpetrator involved. If the sentence says, I didn't say he kicked his dog, well, he's totally a dog kicker. It just wasn't his own dog that was on the receiving end. And finally, I didn't say he kicked his dog. He clearly kicked something. It just wasn't that. There's a lot of different ways to read that sentence. And text messages and emails, for all their advantages, really miss the verbal cues. So phone definitely has some advantages to be considered, and video some even more advantages where you can read body language, you can see if someone's smiling, is this sarcasm, is it a joke, do you mean it literally? I have been guilty of having to send a message to someone in writing and have them come back saying, I'm not sure what you meant by that. I'm thinking it's really self-explanatory, the words are all there, and then understanding how they maybe read it in their head with a different pattern. So what is the message to auditors? All of these communication methods have their place. Sometimes picking up the phone for a quick call is the quickest and easiest way to get an answer, and efficiency is important. Sometimes an email is the most thorough way or the best way to transfer a document or to be able to ask a question that isn't time sensitive and allow someone to respond offline. But there are other times when we just need to schedule a time, have some video person-to-person communication. At our firm, we like to schedule periodic status meetings throughout an audit. Depending on the engagement, that could be checking in with a client every day at 4 or once a week or once every other week, depending on what fits well for our needs and their needs. And they don't have to be long conversations. They could be 5 or 10-minute check-ins just so everyone's on the same page. If we were physically doing the work in an office, we'd have the opportunity to pop by each other's offices or workspaces throughout the day. Video can be a great way to pick up what's lost there during this remote work environment. Other things to consider when it comes to remote field work is the steps that the auditors have to go through to evaluate the evidence that they've received. So there's a hierarchy of audit evidence, and this is not new. The auditing professional standards have addressed this all along. So sometimes the way an auditor gets an answer is by asking a question. The official term of art for that is inquiry, and it's a good way to get an answer. I'm not sure why this is. I ask management, management answers. That's inquiry. That is an audit procedure, and it provides some good evidence. Better than inquiry is observation. Don't just tell me what happened. Let me look at it. Let me see a transaction. Let me see a physical asset. Let me see a process taking place. And of course, the gold standard of audit evidence, which is great when it's available but doesn't work in every context, is third-party confirmation, or an independent party who has no skin in the game, they don't care what the answer is, can independently confirm. Confirmed bank balances, confirmed receivables, confirmed debt balances. Basically, when there's a third party involved that can tell you what the transaction amount is. So auditors are going to use all three of these. They're going to ask questions. Inquiry is great. They're going to observe what they can, although that process of observation is going to have to take a different form. So one of the classic examples with observation would be inventory. Well, governments don't have inventory in the same way that for-profit businesses do. Some governments do have inventory balances that are material enough and have enough of a engagement risk profile to them that the auditor needs to do something to physically observe the inventory, see it's actually there, and then apply some valuation techniques. Well, if stay-at-home orders or physical distancing issues are impacting the ability to do that, then there may need to be some kind of additional or different approaches. And we'll talk about that one in a later slide. This practice point on the right is important. Professional standards, that would be generally accepted auditing standards, address what evidence an auditor needs to obtain, but they really don't get into the how, which means whether you're making that inquiry in person or on the phone or via email or on a video chat, the standard says it's inquiry. If you're observing something in person or on the phone or over video, it's still an observation. Now, we have to satisfy ourselves of certain, information is still appropriate. And Zoom, in particular, is a great platform because you can Zoom from a cell phone, from a tablet, and that makes the camera extremely mobile, certainly more than carrying a big laptop around or a desktop with a webcam. And so observation remotely was not necessarily considered as a viable option when the standard was written, but it so totally becomes one going forward. And the same is true for confirmation. Confirmations originally started as paper mail going back and forth through the U.S. Postal Service. Confirmations evolved to include fax machines, and then it evolved to include email, and they'll continue to evolve. Confirmation could take place over the phone or a Zoom chat. There's a lot of different ways. The professional standards tell you what to do. They don't tell you how to do it. Auditors, you've got some flexibility there to use emerging technologies and document it well. Now, you may be surprised to know that AUC Section 500 already addresses how to evaluate electronic information. This wasn't written for the pandemic. It just says that auditors may receive information through a variety of ways, and one of those ways might be electronic information. And auditors need to consider the reliability of that audit evidence, the same way they consider the reliability of all audit evidence. It could be impacted by the accuracy, the completeness, the authenticity, and the susceptibility of evidence to management bias. Is there a way that management could impact or change that electronic information? And auditors just need to apply professional judgment. We're explicitly told it's okay to use electronic means and accept electronic information. Getting a scan of support instead of the physical paper of support is acceptable. But auditors are also warned, or at least admonished, to consider the authenticity of the documents. So is what I'm looking at really what I'm looking at? And so we have kind of this old school approach of, well, I need to look at original documents, not copies. And I put originals in quotes here because if we think about it, I would argue that the time when we could look at a paper document that's handed to us and say with certainty whether it's an original or a copy probably passed a number of years ago. The standard everyday office machine that can produce high quality, full color photocopies is no longer a rarity. Lots of governments have that. The nature of official original documentation only existing electronically, being printed black and white on a laser printer, being emailed and not printed at all, is becoming more and more common. I would challenge that in most cases, we probably haven't been able to substantively determine what are originals and what are copies for years. So auditors, while you still need to use professional skepticism, while you still need to consider reliability and susceptibility to tampering and everything else, recognize this is not conceptually all that different than what we've been dealing with for many, many years. We need to give some consideration to and understand the implications of internal control. The auditing standards in section 315 tell us that we need to understand an entity and its environment, including its internal control. And internal control for many governments, especially June 30 year ends and later, are going to fall into three buckets. We've got the internal control structure as it existed before the pandemic. Pre-COVID-19, this is how we did things. Then we have the internal controls as they existed during stay-at-home orders. If you were sheltering in place and business still had to happen, there may have been modifications to workflow that changed the internal control environment on a temporary basis. And then we've got today, which might look like it did pre-COVID-19. It might look like it did during the stay-at-home order, or in many cases, it may be some sort of a hybrid between those. And so an auditor who needs to understand and do walkthroughs of internal controls as part of their audit work may find that it's necessary to consider all three of those different systems of internal control, and it might be necessary for them to document each of them independently. Now, I do want to point out one distinction, and that is the difference between an internal control and a process. Now, this difference, in my mind, is that a process involves initiating or recording a transaction, where a control involves actually approving a transaction or reviewing or reconciling it after the fact. And there's a huge difference between how we do things, processes, and how we review and approve things, which are controls. And that distinction may be such that you'll say during the pandemic, the controls that were in place pre-COVID-19 didn't change. They were, what we did pre-COVID-19 is so-and-so did it, and then they printed it out and they walked a piece of paper over to their supervisor, and the supervisor reviewed it and signed off on it, and then it got filed in a physical 3-ring binder. And during the stay-at-home order, the same person did the same work, only now they emailed it to their supervisor, who reviewed it electronically on their laptop, and they signed off on it digitally, and it got filed away. And you say, well, that process is totally different. I'd say, sure, the process is different, but the control, the independent review and approval by a supervisor, didn't change a bit. So watch for that distinction. As auditors, we need to understand internal controls, and the process is important. It helps to know how our clients are doing things, but the main thing that matters is what our controls are in place, and those may not have changed. So make sure you have that conversation with your clients and understand both. All right, let's get into some other miscellaneous considerations that may exist. We're going to talk about just a quick kind of one-off at a time here. We've got inventory observations. If inventory is important to a governmental audit and the timing is such that you're unable to do a physical observation on the last day of the fiscal year, there are options. Maybe it's because the client didn't do their own test count that day because they were closed for pandemic-related things, or maybe it's that the auditor wasn't able to travel and be on site. So if the procedures if it can be observed on another date, you can roll that forward or back to the actual fiscal year end by keeping track of the transaction volume. Depends on how many transactions there were and how much there is. Or you could actually do a real-time video observation using something like Zoom or FaceTime or whatever platform you want. And this is actually not new gas. This is written into the auditing standards for years. AUC section 501, paragraph A34 says, in some cases, attending a physical inventory counting might be impractical due to the nature or location of the inventory, or where the inventory could pose threats to the safety of the auditor. Well, the chief auditor for the AICPA officially weighed in and said, I think COVID-19 meets that definition, that the location of the inventory, which is out and about with people during a shelter-in-place, stay-at-home order, poses a physical threat to the safety of the auditor. Therefore, the standards say you don't have to physically attend an inventory, you can use other options. And you have to use professional skepticism and good appropriate care and provide some two-way communication to make sure you're not just seeing a recording of an inventory, but actually interacting with a person. Hey, let's take the camera and let's aim it over here now at the right angle. I want to see these things, and I'll pull this one out and pan over. And yes, there is a risk that somebody could be doing things off camera to fake the inventory. That risk exists if you're physically on site doing an inventory count. Consider the risks, but don't go crazy with it, and just make sure it's part of your risk assessment process. Fair value of investments. We mentioned it on the accounting side, but the market has been all over the place. And because of that, there could be a market impact, especially for your category 3 investments. Those are the investments that are not pegged to actively traded markets. Auditors need to consider that it may be more challenging to audit fair value. You may need to plan for that early. You may need to consider whether you have the ability to gain competent, sufficient audit evidence for those. There's no easy answers here. Just recognize that measuring and auditing fair value may be impacted, and you'll have to adjust your approach accordingly. As part of an audit, we typically do what we call a search for unrecorded liabilities. That's where we're going to flip through bills that were paid subsequent to year end, or maybe unopened invoices that have not yet been paid subsequent to year end, and look through those to see if there are any accounts or items that should be liabilities as of the end of the fiscal year, things that should be booked back. Well, our normal approach of maybe considering the first X number of weeks or months after year end could be impacted if a government was either closed and not processing invoices as timely, or was experiencing cash flow issues and was intentionally withholding or payment or delaying payment. So if a client is slower paying bills, or the process of collecting and entering bills into the system to even get the payables booked has been impacted because things are being sent via physical mail and they're being quarantined for a couple of weeks before people open them, there's so many different things that could be happening there. Don't assume last year's method is still going to work well this year. Less of an issue for governments than in the nonprofit world, but we do occasionally see debt covenants or other requirements that are written into bond indentures. And when an entity is in violation of a debt covenant, it could have an early acceleration clause for having to pay the debt sooner, which could impact the classification of debt as long-term or short-term. What we're seeing on the commercial side of the audit practice is that banks are overwhelmed with these requests because all of their customers, or very nearly all of them, are impacted by the economic impact of the pandemic. So whether an audit firm is comfortable accepting an oral waiver from a bank or a written waiver, and if you can get that timely, and all the forms we use are only in the office, all of these are considerations auditors are going to have to really think through as part of dealing with those sorts of debt covenants. We talked earlier about the difference between subsequent events. Type 1, which are those that we recognize and actually book a debit or credit for. Hopefully debit and a credit, those kind of go together. And type 2 events, which are not recognized, things that we would not put in the books. Well, in general, COVID-19 are going to be type 2 non-recognized events, although there could be some type 1 events to consider. We need, whenever there's a subsequent event, disclosure. Management is the one making disclosure. The financial statements belong to management, even if the auditor helps draft them. The auditor then has to consider the auditability of that disclosure. Is what management has said happened something the auditor can get comfortable with and sign off? If management on a government wants to say something that the auditor just doesn't feel comfortable signing off, well, then we've got other options. We've got the letter of transmittal or MD&A as other places that management can make disclosures that are not subject to audit coverage. And COVID-19 may delay the issuance of audit reports for a number of reasons, not the least of which is we're still awaiting some significant guidance on single audits. And while the financial audit might get issued ahead of that, The timing of auditors' reports may be delayed. The time from when an auditor sends a final draft and says, we're ready to go to press, can we get you to sign the rep letter? Management may require additional time for that process to go through. And so auditors have to update their procedures through the end of the period where the representation letter is signed. And so be very mindful of all of those dates and recognize that some things are taking a little longer in this environment than they might otherwise have taken. Auditors are required by what was originally SAS 99 to make inquiries about potential fraud risk. And it sounds a little weird to go to a client and say, did you commit fraud? But believe it or not, there are people who will answer yes because they were that close to confessing anyway. And so auditors ask, are you aware of any fraud in the organization? I'm not saying you committed fraud, but do you know of anybody else maybe who did? And things get brought to our attention through those inquiries. Well, just like our earlier conversation about the different ways of having communication, written, with emails, telephone, video, the auditor needs to consider how they go about making these inquiries. And we need to consider the fact that the likelihood of fraud may have been impacted. We may actually have seen an increase in fraud risk factors due to changes in controls, fewer people working on site, access to company records being taken home. It may just be a whole different environment. So fraud risks could be impacted. Key personnel may have either changed responsibilities, they may have been laid off temporarily. And so fraud risks themselves can be heightened. And in order to respond to that, when we have our inquiries, our meetings with folks, the strong recommendation from the AICPA would be to use video conferencing where possible. Read body language, make eye contact. They don't have to be long conversations. Fraud risk follow-up could be a 3-minute call, but it's, hey, we're going through an audit. Part of an audit means making a number of routine inquiries. If you don't have anything to share, it's not a big deal, but we do want to go on record as asking. So my question, in your role in the organization, have you seen anything that you think is possibly indicative of fraud? Maybe they say yes, and you dig deeper. Maybe they say no, and you say, great, that's really all I needed. Thank you for your time. But that conversation, do they seem evasive? Does it seem like there's more they want to say and just the next prodding question would have been enough? Really consider using that, especially in this environment. We talked about going concern from an accounting perspective. Here's the auditing angle. Are there events or conditions that raise substantial doubt the entity, the government, can consider as a going concern? This is something that management's already evaluated on the accounting side. The auditor needs to as well. And remember, the definition under GAAP and GASB for substantial doubt is it's probable, meaning it's more likely than not that they won't continue. So we don't see the ultimate conclusion being, yes, there is substantial doubt very often. There's usually a pretty good indication the government will continue. But if there is substantial doubt, management is supposed to share their plans in the notes, and the auditor has to consider those plans, and is that enough? Does that address the doubt? Does that give us enough to work with, or is there more to it than that? Management representations at the end of an audit. We may consider auditors asking our clients to make some additional representations, maybe addressing unique economic risks or uncertainties that might be outstanding. We might ask for certain COVID-19 specific representations. An entity that received PPP funding, we might ask for a representation that that money will be used in accordance with program requirements. An entity that received coronavirus relief funding, we might ask for a specific representation about how those funds are being applied. That's something an auditor will have to work through on their own. What are they comfortable with requesting and receiving? But don't be surprised if there are some tweaks to this year's management representations. We ran into some issues during the stay-at-home orders of clients saying, I can't sign a representation letter. I've reviewed everything at home on my laptop, but I don't have a printer, I don't have a scanner. There are some great options. First of all, the AICPA has reiterated in writing the best practice, the long-standing best practice of having management representation letters be on client letterhead is just a stylistic best practice. It is not required by professional standards. So while I would not discourage anyone from doing it if they can, if putting the rep letter on letterhead is a real burden, just type the name of the government at the top. It's fine. That's allowed. If hand signing a document is a problem right now, anybody with an iPhone, if you receive a PDF via email, you can tap on it and sign it with your finger and email it right back. I'm sure there is a comparable method in Android. I just don't have an Android, so I don't know how to do that. You can use electronic signatures. We can use Acrobat signatures or e-sign, DocuSign, different online packages to handle that. Any of those are acceptable, subject to the auditor's own internal risk assessment and what they're comfortable with. So first choice would certainly be to have on letterhead and signed in a way that is very clear who did it. But we recognize in these times, we have to be a little flexible in how we do this. When it comes to supervision and review, that's a required element from the auditing standards. Anytime there's an audit, the audit needs to be appropriately supervised and the work papers need to be reviewed. And this process of working independently, everybody at home on their own separate workstations, working off-site, this has been a blessing for some people. There are introverts among us who are cheering for the change to their work environment under the pandemic. And it's been a burden to others. There are some who have felt crushing loneliness and a significant loss of productivity without the personal interaction with their colleagues. And so without knowing which of those two camps or anywhere on the extreme, the continuum between them people fall, we just need to check in regularly. So seniors, check in on your staff. Managers, check in on your seniors. Partners, check in on your managers. Have team meetings. Have regular check-ins with the client. I know people who will keep a chat window open all day for regular conversation. I've heard others who will keep a video open all day, although you're pretty brave to do that. We do that during the day, right? I mean, when we would be physically sitting around a conference room at an audit client and working there all day, we all saw what was happening throughout the day. So it's not that much different. It's a little weird to have a camera into your home or your living room watching your cat walk across your keyboard or whatever it is. But whatever it takes to keep that supervision review working, make sure it's happening. Don't just rely on written communication. Email's great, review notes and audit software are great, instant messages are great, but add the personal touch, at least periodically, to see how people are doing and not just have them typing all as well. Now, in those situations where you find yourself absolutely needing to modify an opinion, the auditor says, I simply cannot support a clean opinion. AUC Section 705 addresses what to do here. And this little chart walks us through, is the matter material but not pervasive, or is it material and pervasive? So it has to be material. If we're talking about something that's immaterial, we're not going to impact our opinion for that. But we have a material issue that is so pervasive it affects all aspects of the audit, or we have a material issue that's isolated. It's not pervasive. It impacts certain parts, but not all of them. So my question is it that the financial statements are materially misstated? Well, if it's not pervasive, that's a qualified opinion. In our opinion, the financial statements are fairly presented in all material respects except for this one thing. That's my qualification. If they're misstated so holistically, then that's an adverse opinion. The financial statements are not fairly presented. Or if the auditor says, I don't know if they're misstated or not, I simply can't get enough audit evidence. The pandemic has crippled my ability to get answers to certain questions. If that is not pervasive, you could have a qualified opinion for a scope limitation. We've conducted our audit in accordance with GAS, except for this one area we weren't able to look at very well. And so our opinion is that the financials are fairly presented, except for this one area that we weren't able to look at. If it's so pervasive that we just can't get any audit information, we just cannot get enough evidence to support an opinion, then you issue in a disclaimer that says, I'm not saying the financials are right, I'm not saying they're wrong. I'm basically saying I throw up my hands and give up. I cannot give you an opinion. I disclaim to even offer an opinion on these financial statements. Hopefully this matrix is something you don't have to reference very often, but here it is in case you need it. And with that, let's take our fifth CPE prompt. Are you still there? In our next section, I'm going to share with you some best practices for auditors to consider documenting their clients' response to the pandemic. COVID-19 has had a significant impact on our clients. It should also have a significant impact on our risk assessment. We need to at least document that we understood what happened and how it impacted our client. Depending on their fiscal year end, depending on whether they were open or closed, depending on how much their constituents have been impacted. The degree and nature is going to vary substantially. But this is a sample practice aid. We're going to put it on slides and kind of walk through it. Questions you should ask, questions auditors should document in order to make sure that their own risk assessment has addressed things properly. So we're going to walk through kind of the standard memo that I use at my firm, and hopefully you can get some ideas for working in your own audits in the future. So the first question is, tell me what your government's response was to the stay-at-home order. So did you suspend on-site operations? If so, when did that happen? Did any operations continue operating like remotely? If so, what were those? Have any on-site operations started back up again? If so, when did that happen? And are there any remote operations that have continued? If so, what are those? Basic overview questions of what are you doing on-site versus off-site? When did it stop? When did it start? That information will give the auditor the needed context for deciding how significant might independent control environments have been throughout the year. The second question would be to describe any economic actions that the government took in response to the pandemic. So did you have to lay off any employees? Did you furlough some employees? Were there any pay reductions? I've seen all of those and combinations of them at my client base. Certain positions that were eliminated outright, certain positions that were furloughed for a period of time and are now back, certain positions, or they said, we're taking a 10% pay cut for everybody in this particular category so that we don't have to lay people off. What about other cuts to the budget? Were there other areas where we see costs being removed, budgets being pulled back? Were there any official contract modifications where you actually signed an updated agreement, an addendum that changed maybe rent or a lease agreement or something like that? Was there any debt that was formally restructured, more forgiving payment terms, a payment holiday, a change in the interest rate being applied, just spreading out the time period over which debt is being paid? And was there any COVID-19 specific funding that was received by the government? PPP loan, economic injury disaster loan, any other kind of similar funding? If so, what's the current status? Have you incurred eligible expenditures? Have you claimed reimbursement? Is it sitting in an account earning interest, waiting for you to decide how you're going to apply it? Did you pass it on to others? All of those things are going to be essential for the auditor understanding what the government's response was to the pandemic. The third group of questions talks about internal control. So in connection with the pandemic, what changes were made? And for this purpose, realize that a change to internal control is focusing on the way transactions are reviewed and approved, not necessarily how they're processed. So were there any temporary changes made during the period when off-site operations were suspended? Did any of those changes become permanent? Were there any accounting difficulties that resulted from the pandemic? If so, what did you do to address them? Again, much needed context for an auditor to understand the entity, its environment, and its internal controls, and to be able to adjust its risk response accordingly. The fourth group of questions talk about asset impairments. And this would focus on things like investments that may have had material declines in value, receivables that may now be significantly questionable as to their collectability. So we've seen governments who made the decision that even though citizens couldn't pay their utility bills, they weren't going to shut off their water. It'd be a really bad idea to shut off water at a time when we're telling people to please wash their hands. So for public safety, even though they can't pay their bill, we're going to keep things going. Well, that's great, but now 7 months later, those receivables that were piling up, we didn't turn off billing, we just didn't make people pay and didn't shut off services. Are you going to be able to go back and collect? Or realistically, do we now have 4 or 5 or 6 months of uncollectible receivables, and the best people can hope for is to start paying prospectively? That's something the government will need to assess given their unique circumstances. And what about construction projects? If you have a construction stoppage, are there any impairments that need to be recognized relative to that, as we talked about on the accounting side? And our final set of questions relate to cybersecurity and fraud risks. Have there been changes in operations that would expose the organization, the government, to cybersecurity? risk. So if you've got employees working from home, do you have a robust VPN to protect the traffic of data back and forth? What steps have you taken to make sure that your employees understand phishing risks? Now that they're at home and no longer behind a corporate firewall, are they more susceptible to spam links or phishing attacks that are going to take over their computer or install malware or do other things? Has the government's IT department thought that through? Have there been changes in operations that increase the risk of fraud? So we're just asking outright, now that you are thinking about it, are any of the changes that you made, could any of them make you more susceptible to an employee intentionally trying to defraud the government? And while operations either were or are being conducted remotely, what have you done to deal with supervision and review of employees not on site? So maybe the supervisor's not on site, maybe the supervisor is, but the employee's not. How are you handling the important control that is supervision and review? And I've seen different governments tackle this different ways. The regular Microsoft Teams or Zoom meeting is a great option. Periodic check-ins. I've heard from some governments that folks are working a very irregular schedule during the pandemic, and so they may work for 2 or 3 hours in the morning and then take 2 or 3 hours off at lunch and then work later into the evening, and that just works better with their flow and the work's getting done, but it's different. How does that work for staying responsive to questions and being able to supervise and review? These are things we want our clients to think through, and as auditors, then we need to take all of this and synthesize it and answer the question, what do these do collectively to our assessed level of audit risk? Remember, as auditors, our goal is to set the risk of material misstatement, the risk that we're going to drive everything around. Our audit procedures are in response to those perceived risks, and we need to have taken all those answers and synthesized them together and then determine what additional audit procedures or responses are we going to take relative to the answers that we got. So just some good considerations for auditors to think through. In our last few minutes, I want to talk about single audit implications. And this is the area I said I wish we had more information. I'll share what we have, and it's going to have to be the best we've got for the moment. So the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, that was signed into law back in March, it provided a lot of money. $500 billion for economic stabilization, $350 billion for the Paycheck Protection Program, $150 billion for the Coronavirus Relief Fund. Of that, about $4 billion came to my home state of Michigan, and the rest spread all over the place. That information, that money went a lot of places, and we understood that we were going to need guidance. And so the OMB, when they pushed out the compliance supplement, they recognized that when the compliance supplement hit the streets, despite the fact that it too was delayed due to the coronavirus, when we got the compliance supplement in August, it did not include CARES Act money to any degree. There was a few paragraphs here or there about some basic guidelines, and they said, we need to get out what we can now. There's more to come. And so an addendum, a COVID-19 addendum was promised. CARES Act funding went to virtually every federal agency. It was used, it was added to existing CFDA numbers, so existing programs without getting any new name, any new number, suddenly had CARES Act money hiding in them. It also created whole new programs like the Coronavirus Relief Fund with a dedicated CFDA number. And the compliance supplement acknowledged the fact that this list was ongoing, the guidance was still in flux, and they said, we're going to come back sometime this fall with an addendum. Well, this fall is slowly slipping away. At the date of this taping, it is now October 20th, and we have not yet seen the addendum. But we do know that it's coming soon. Soon is probably meaning mid-November right now, and that's a challenge for auditors who are waiting on it for critical information that they need in order to perform procedures. But one piece that we were told in the compliance supplement is that COVID-19 awards should be listed separately on the CFA. We need to have a separate line item. If you've got one program that includes both COVID and non-COVID funding, break it into 2 lines and show them on 2 separate lines with the same CFDA number, one of them saying COVID-19 at the beginning of the description. The current guidance that can be found on beta.sam.gov is that certain programs are not subject to the single audit. So the economic injury disaster loans and the Paycheck Protection Program, despite having CFDA numbers, are not subject to single audit. That's great. The Coronavirus Relief Fund is subject to the Single Audit Act, but only certain parts, and this is really confusing. So subparts D and E of the Uniform Guidance are all of the administrative requirements, federal cost principles, and they're not applicable. The two things that are applicable are the audit requirements and subrecipient monitoring. Well, this raises a very interesting question. How can the audit requirement be applicable? What is an auditor supposed to test if none of the administrative requirements or federal cost principles are applicable? What are we even testing for? Well, the COVID-19 addendum is supposed to answer that question for us. I've seen an early draft. It still left some questions, and the feds are working on updating it, so hopefully we can get some good resolution there. The bottom line is, for Coronavirus Relief Fund, the U.S. Department of Treasury has issued some frequently asked questions, and it looks like the COVID-19 addendum is simply going to reference to those and say, no, you don't have to follow federal cost principles, but what you do have to follow are the frequently asked questions published by the U.S. Department of Treasury. So that will likely be our answer there. Subrecipient monitoring will be important. So entities that received coronavirus relief funds and are passing it on to others, that's states for sure. And some of the larger municipalities, like my home county of Kent County, Michigan, receive money directly. They can then make grants to individual organizations, other governments, nonprofits, even for-profit businesses. And there's a process of going through and evaluating subrecipient risk and all the things that go from the uniform guidance with that. Two big programs that were absolutely subject to single audit: the Education Stabilization Fund for schools, so that includes the Higher Education Relief Fund, HERF, and the Provider Relief Fund for hospitals. Both of those are fully subject to single audit, and both of those are awaiting guidance that will come in this addendum. When you go to our website after the presentation is done, the slides, there should be a hyperlink there that you can go to a summary published by the AICPA. On their website, they are constantly updating the latest and greatest information from sam.gov because this changes a lot. And it'll give you an idea of which programs are in, which programs are out, what we expect to see in the compliance supplement addendum when it comes out. A few quick things. The OMB issued a memo, M20-17, back in March, that provided administrative relief during the early throes of the pandemic and stay-at-home orders. They said grants that would have otherwise expired, we can extend those. Salaries that would ordinarily, you only can charge if somebody's working on a grant. If you're paying people to stay home because that's a public safety issue, you can continue to charge their time to grants. If you're having to cancel events and you're incurring cancellation fees because of that, you can charge those to the grant that was going to pay for the event. You'll pay for the cancellation fee instead. Certain reporting deadlines and negotiating deadlines for indirect cost rates were pushed back, and single audits had all their deadlines pushed back by 6 months. And it was a great memo. The problem was it was only good for 90 days, back when we thought the pandemic wouldn't last long. Well, it was updated with memo 20-26 in June. That extended most of those provisions through the end of September. Of course, that's now expired. The allowability of salaries was carried forward. It's okay to charge to a grant the time of people who would ordinarily have been charged to the grant, even if they weren't working during a stay-at-home. However, you can't double dip with other funding. So if you're using PPP or CARES Act or anything else to pay for those dollars, you can't charge the same dollar twice. That's a normal rule. This is really nothing new. The single audit extensions, that wonderful 6-month extension that we thought we were getting, only applies to fiscal year ends through September 30 of 2019. The 12/31/2019 year ends only get a 3-month extension, and there are no extensions after calendar 2019. And so by 12/31 of 2020, all extensions are off the table right now. Could that change in the future? Anything could change in the future, but for now, that seems to be where they're leaning. The reason is the federal government really wants to hear, they want results back as quickly as possible. They want to get as much of the single audit, these programs audited and back to them for timely feedback as they can. And they view extensions as contrary to that. the AICPA is pushing back hard. It's going to be mid-November before we have the addendum. It's kind of hard to audit these programs, and we're going to get into the traditional CPA busy season with calendar year ends, and so that battle continues. We'll see what comes of it. Let's do our last CPE prompt, and then I'll close this out with just a last few very small considerations. If you like having materials, you can answer this question on how to get materials sent to you, and we'll take that into advisement for future dates. All right, a few last considerations. The single audit data collection form is normally due 9 months after the fiscal year end or 30 days after the data report. Make sure you consider revised due dates there. It's submitted electronically. No major changes this year. Do realize that COVID-19 has created some processing delays, so we are seeing in some cases a bit of a hang-up from when someone uploads their single audit to when it finally gets approved by the clearinghouse, so don't be alarmed by that. Just like the CFA is supposed to have COVID-19 funding on a separate line, we have been asked to do that in the data collection form. So box C is the place where additional award information or additional award identification can be made. And the request is to put the letters COVID-19, COVID-19, in that box, and that will make that a text searchable field in the database to identify COVID-19 money. So just watch for that when you're updating your single audits. And I will say as we're wrapping up here that both the GASB and the AICPA have agreed that in order for revenue to be recognized from federal grants, and in order for expenditures to be reported on the CFA for a single audit, there has to have been an award as of the end of the fiscal period being reported. So here in my home state, Michigan, there were a significant number of June 30 year-end governments that got funding awarded to them in July of 2020, one day or a few weeks after the end of the fiscal year. Even though that funding may be intended to cover costs from in the fiscal year, because the award didn't exist as of June 30, the revenue can't be recognized until the next fiscal year, and the expenditures don't go on the CFA until the next fiscal year. So the good news is there'll be some matching there, but do watch for that. Your facts and circumstances may vary, but you need to have an award letter, an executed award agreement, or its equivalent in the case where there won't be one, in order for revenue recognition to occur in expenditures on the CFA. So with that, I have been keeping my eyes open for questions. I don't see any new that have come in now, but I'll turn things back over to Sam to wrap us up.